Okay, let's dive right into this. Welcome to The Explainer. Today, we're talking about a completely transformative shift in how you interact with your money. We're talking about a mental shift that takes you from being this stressed out market spectator to a calm, calculated business owner. Have you ever found yourself just staring at your phone, watching those little green and red lines go up and down, and actually feeling your heart rate spike every time the market dips? Well, if that sounds familiar, I've got a bit of a hard truth for you. You aren't actually investing. You're really just a spectator in a casino. And honestly, that is exactly why you're so stressed out. So let's move right to section 1, unpacking the company basket. Now, what's really interesting here is that to fix this whole casino mentality, we need to completely change how we look at the market. Forget those confusing flashing numbers on a screen for just a second. Instead, I want you to think of a company as a giant basket filled with valuable stuff. What's actually inside that basket? Well, some of it is physical, right? Think trucks, computers, buildings. But the absolute most valuable parts of that basket are often things you can't even touch. We're talking intangible assets, like a brand name or a rock-solid reputation. Take Apple, for example. Sure, they have these massive warehouses full of physical iPhones, but their real magic is a brand so powerful that people will literally and happily pay twice as much for their product compared to anyone else's. And this brings us to a foundational truth of this explainer. When you buy a stock, you aren't just betting on some random screen price. You are actually buying a tiny, literal slice of that entire basket, all of those tangible trucks, and all of that intangible magic. Which brings us to section 2, lender versus business owner. What is your role? Now here is where a ton of confusion usually happens. Let's say we have a local carpenter who needs $20,000 to start up a shop. If he borrows $10,000 from his friend Jake at a 5% interest rate, well, Jake's a lender. His risk is relatively low, and if the business goes under, he gets paid back first from whatever cash is left over. But what if you put in the other $10,000 to actually run the shop? Well, now you are the owner. Your risk is significantly higher, and as the owner, you're the absolute last in line to get paid. But look at the flip side of taking on that risk. If the business absolutely booms, Jake's reward is strictly capped at that fixed 5% interest rate. He gets his 5% and honestly, nothing more. You, on the other hand, as the true owner, you keep absolutely everything else. That means unlimited potential simply because you truly own the future of that company. The big problem, though, is that most people simply do not treat stocks like a business. They treat them like a lottery ticket. Think about it. If your buddy offered to sell you his local pizza shop for $50,000, you'd probably spend weeks counting the customers, tasting the food, and meticulously checking the books before you ever risked a single dime. Yet when it comes to a famous tech stock, people will literally read one single tweet and just hit buy for $10,000 without a second thought. Why the massive disconnect here? So, the crucial point is captured perfectly right here by Benjamin Graham. You know, the guy who famously taught Warren Buffett. He said, a stock is a business, and if you wouldn't buy the entire company yourself, you shouldn't buy a single share. It is entirely about grounding yourself in the reality of true business ownership. Moving on to section 3, surviving drunk Dave and market mood swings. Okay, so to survive as a shareholder, you absolutely have to learn to ignore a completely chaotic, hypothetical business partner. Imagine you co-own that pizza shop we talked about with a guy named Dave. And every single day, Dave shows up completely drunk, just throwing out these wild offers to buy your share. On Monday, he casually offers you $500. Then Tuesday rolls around, he's incredibly depressed, and he only offers you $50. But by Wednesday, he's absolutely manic, screaming that he'll pay you $5,000. Now let me ask you, would you ever let Dave's wild mood swings dictate what your actual business is worth? Of course not. Yet, crazy enough, that is exactly what people do when they check the stock market every single hour. The underlying business didn't change at all, only the price did. Smart shareholders fundamentally understand this core lesson. They ignore the hourly checks, and they only ever make a deal when Dave offers something truly undeniably ridiculous. Which nicely brings us to our final section, the shareholder identity and building real wealth. Now, I know exactly what you're probably thinking right now. I don't have the time to research individual companies like a Wall Street professional. And hey, that is perfectly okay. Actually, it's reassuring because even the professionals rarely beat the market over a 20-year span anyway. You really don't need to try and outsmart them. The simplest, most low-effort solution to becoming a true shareholder is an index fund. Think of it as just a giant basket holding tiny slices of hundreds of different companies all at once. When you buy a globally diversified index fund, you are essentially placing a massive bet on the future of humanity itself. You're basically saying that you believe 20 years from now, people are going to be more developed and much more productive than they are today. And this brilliantly illustrates the ultimate identity shift. Because you see, this whole journey is about behavioral psychology just as much as it's about the math and the money. Stop telling yourself, I'm trying to invest, and start proudly telling yourself, I am a shareholder. It completely changes how you carry yourself. A spectator worries about the price today, frantically trying to be the smartest person in the room. But a shareholder? A shareholder cares about the value a solid decade from now. It really reinforces this massive paradigm shift. True, real wealth is built through patience and discipline, definitely not by reacting to everyday market noise. So I'm going to leave you with this final provocative thought to really challenge you today. Take a look at your portfolio right now and ask yourself, do you actually own businesses you truly believe in, or are you just blindly following Drunk Dave? If you're ready to stop gambling and finally start getting your time back, dive into our Psychology of Money playlist to keep learning. Thank you so much for joining me on this explainer, and I'll catch you next time.